Hello everyone, welcome to my channel again. If you're new here, my name is Ellen. I am a chartered financial analyst. Today I'm going to share with you a quick insight into comparisons of different strategies for buying into a leveraged ETF fund called TQQQ. I have made a few previous videos on this particular instrument and I hold it personally in my retirement account as well. It has a lot of potential for great upside for either trading or holding for the long term. So today I'm going to test 3 different strategies. Number 1, investing a lump sum into this ETF. Number 2, dollar cost averaging on a monthly basis. And number 3, value cost averaging. It's new on this channel, so I'm going to illustrate what value cost averaging means and how it works in reality. And then I'm going to show you how each of this strategy delivers in terms of returns in TQQQ over a 15-year period. So from about March 2010 to October 2025. Without further ado, let's get started. For those who don't know, value cost averaging means instead of putting in $100 each month, like in dollar cost averaging, you would bring your balance up to $100 more than a month ago. So to illustrate that, let's say month 1, you put in $100 at the price of $1. And by month 2, the price has increased to $1.5 per share. So that means your holding is now worth $150. Whereas last month it was $100. So now it's worth $150, then you would only put in $50 instead. So that would bring the full balance to $200. And then month 3, the share price, let's say it dropped to 75 cents. So half the price as the previous month, which means your holdings would now be worth only $100. So in that case, then you would put in $200 because the target total value for month 3 would be $300. So now you have $300. So this is the principle of value cost averaging, meaning when the stock price is going down, you would put in more money, you would buy more shares. So you would buy at a good price point. Whereas when the stock price goes up, you would put in less money, reduces the overall price you are buying a stock or ETF at over time. It sounds like a pretty good way to buy stocks and ETFs in theory, but let's have a look at how it pans out in reality. This is a spreadsheet for the backtesting data I've done. So as you can see, I've started the testing from the 1st of March 2010. The closing price for TQQQ was 0.49. I think that's in dollars. And then would go all the way to 17th of October 2025. And this is the price. 103.99. I've tested investing a lump sum from the very beginning, or DCA, dollar cost averaging, on a monthly basis, and then value cost averaging. So the lump sum strategy would be investing all of the money from the very beginning. So if you invested $100 per month throughout this timeline, then you would have invested $18,800. And value cost averaging follows a similar principle. Although the aim is to bring the total value of your portfolio, of your position in TQQQ to $18,800 by October 2025. If anybody would like a copy of the detailed workings here to kind of study it in your own time or change some of the settings to test out different scenarios, please feel free to request so in the comment section and I will get back to you. So here is the comparison clarified in a chart. The blue is the profit you'd make in lump sum strategy, and red is the dollar cost averaging strategy, and the yellow is the value cost averaging. It's clear here, even though value cost averaging seems to be a good idea in theory, but in practice it actually works out worse. It doesn't make a lot of profit. I have to say all three strategies are in the green at the end of the day, meaning they all made profits. They're not losing money after 15.5 years. But there is also opportunity cost you have to take into consideration. As you can see here, on the very last day, the profit for the lump sum strategy would be almost 4 million. But the profit for dollar cost averaging would be 688,000, and for value cost averaging, it's a mere 75,000. About that. In comparison, though, the profit and the value of your position with the value cost averaging strategy is a lot less volatile. So there is that to take into consideration. So it would feel like you are taking less of a risk. You're not having to watch your money go up and down so drastically throughout this time, albeit you would have to maintain this strategy, like monitor your position a lot more actively. You'd have to do some calculation once a month to see where your position is at and how much you need to put in. So it's a manual process, whereas dollar cost averaging, you can do it automatically. And with the lump sum, then it's just once and buy and forget kind of strategy, so no maintenance whatsoever. So yeah, that's the result. What do you think about these three strategies? Which one is your favorite? Balancing between returns, volatility, i.e. risk, and effort of maintenance. What would be your choice? If you care to share, I'd love to hear it in the comment section. That's it for today. Thank you so much for watching. If you enjoyed this video, please give me a like and subscribe to my channel for future videos like this. If you have any questions or comments, please feel free to leave them in the comment section. I would love to interact with you over there. See you next time.